everyone, thanks for checking out another one of my videos. My goal is always to try to bring perspective and clarity to what you may be seeing and hearing in the news headlines. So please make sure to click the like button below for this video so YouTube can work its algorithm magic and more people can hear this much needed information. Okay, so I've gotten quite the number of comments recently referring to the current real estate market downturn. I mean, we've been in such a chaotic and frenzied market for so long that a somewhat normal market with reasonable days on market and inventory levels seems to bring with it thoughts that we're suddenly in a falling market. Granted, rates rose so quickly that it did feel like, and honestly was, a big shift in activity over a very short amount of time. Very quickly, we went from multiple offers, bidding wars far over asking price, and sellers basically getting whatever they wanted to a much more quiet market with a big downturn in buyer activity. However, as I've continued to say, a shift in the market doesn't necessarily mean a downturn, and especially not in the sense of what we saw during the financial crisis. We've lost a lot of perspective of what a normal market is, and we're just so used to getting multiple offers the first weekend that it feels like the market is trending downward just because of such a rapid change so quickly. However, it was so active before that we're again measuring against something that was abnormal and, quite frankly, not sustainable. When you're measuring numbers, you have to make sure you're not just measuring against recent data, but against historical norms as well. It's true, the headlines just scream the general message of market downturn. Article after article talks about the slowdown in buyer activity, increasing inventory levels, and woes with interest rates and affordability. But the question is, and always should be when reading a headline, how much truth is actually in these statements? Unfortunately, most people stop at reading just the headline and then draw a conclusion from that, which usually leads them to either assume something completely false or at least more extreme than the reality. Let's face it, the purpose of an article headline or a video title is to entice you to click, not to give you an answer. So let's first take a look at price growth. Holy moly, that's a huge cliff we're dropping off of. Maybe we are in a downturn. Oh wait, that's just dropping down from the astronomically unsustainable price growth we've seen during the last couple of years of unprecedented stimulus and artificially low interest rates. Yes, it does show a potential forecasted pullback in house prices, but at first glance at this chart and the huge drop off, it seems much worse. You see, it would be really easy to take this data and spin it to say that this is a 125% decrease in home price growth, because technically it is. But that's making it appear far worse than the reality, a potential 5% drop in prices, which is much more reasonable to swallow, because you're running the numbers against a huge prior growth number. The same can be said when looking at down home sales, which you could say are down around 17%. And they are if you compare recent existing home sales numbers to what they were as recently as January of this year. But they are right in line with what the numbers were back in 2019 and pre-COVID 2020. When comparing a lot of the current market metrics to recent history without looking back a bit further, it absolutely looks terrible. But looking back a bit further, you can start to see a bigger and more clear picture and more accurate data to compare to. As interest rates have risen, it's no surprise affordability has taken a massive hit, as a number of markets across the country have seen average house payments spike as much as 50%, mostly from those changes in interest rates. The Western markets hit an ugly under 70 on the affordability index, which a year ago was just under 100 being the just barely affordable number. Southern markets were 153 on the affordability index a year ago, but are hovering at barely above affordable at 101, down from 108 just 1 month ago. We've already started to see the effect on inventory levels as absorption has slowed, with less buyers able to qualify and others skittish to get in or stay in the market, or simply unwilling to be making a higher monthly payment. However, we're nowhere near a glut of inventory, at least not yet. My local market of Portland, Oregon saw an increase in inventory, now at a still extremely low 1.4 months, and has average days on market that remain at only 18. These are hardly numbers that support a narrative of a market that's currently in a downturn. Nationally, June numbers showed an annual increase in inventory of 19%. By the way, the Portland market increased almost 47% from just the prior month, with just over 4,000 active residential listings in June, up from just under 2,800 in May, and yet remain under a month and a half of inventory, even with such a large increase. So a large percentage of increase doesn't tell the entire story. Even with this increase, overall inventory is still about half of pre-COVID levels. Don't forget that the summer sales season already historically has an uptick in listings as well. So looking at just the percentage increase versus a prior month without taking into account absorption rate and ignoring that a piece of it is also normal seasonal increase skews the picture and makes it look much worse. Taking this and just drawing a conclusion, inventory is way up, so home prices must then be falling, right? Would again be a false assumption, as the median home price also hit a record high in June, now at $450,000, up 17% year over year. Part of this increase is due to bigger number of large homes and more expensive homes, which is another point I often make, that comparing home prices now versus decades ago to try to make the case that housing is overly inflated is a completely inaccurate picture if you aren't also taking into account the huge change in average home size along with that increase in price. With higher mortgage rates and prices, the payment on the median home price now takes up almost 32% of the average wage, way up from what it was this time last year at only 24%, and well above what many lenders consider to be a max housing ratio of 28%. Also along the lines of affordability, CoreLogic has come out with several reports recently stating which markets they consider to be overvalued. But even their own reports have what at the surface appears to be contradictory conclusions. Take for instance their report on which markets are overvalued, and almost all of Florida is highlighted as such. Not only that, on a prior report it shows many of those same areas on the highest level of being overvalued. If you look at just these studies alone, you'd quickly draw the conclusion that prices in those markets are about to drop, and by a lot. However, looking at the report showing which markets have the highest chances of values dropping, those same markets are in the lowest ranges on the map. Why? I don't know the nuances of their conclusion and how these two seemingly opposite data points can go together, but I'd venture to guess at least a portion of it has to do with overvalue being based on today's income levels and housing prices in the area, but that the trends point toward a strong local economy, positive net migration numbers, and job and income growth that can support these new and upward trending price points. In the lending world, mortgage giant loanDepot just cut thousands of jobs and has plans for more cuts as lending has slowed significantly with the rise in interest rates. They're definitely not the only ones to make such cuts, as many large lenders cut back on overhead and expenses and now unneeded employee base. Mortgage applications have cratered. However, and not surprisingly, the refinance applications are what have taken the hit. While purchase applications are down, they're down a much smaller amount compared to refinances. A lot of these larger order taker lenders beefed up for the refinance boom and are now not able to keep that large overhead as refinances have all but ceased. This is normal and predictable. As large lenders see opportunity to cash in on a refinance boom, they add to their employee base to take on the increase in volume and profit from turning as many applications as possible, with the full intent to just pull out the layoffs when business inevitably slows. Once again, just looking at the overall combined loan applications or the large number of layoffs by lending institutions without digging deeper leaves you without enough information to draw an accurate picture of what's actually happening. With questions about the economy, construction costs way up, and interest rates hurting affordability for buyers, home starts are starting to take a big hit. New permits are down, and home builder confidence continues to decline. Home builder confidence was down 12 points to 55, which is the second largest single month drop in the index history. Some builders are halting construction, citing continued supply constraints, increases in costs, and inflation as culprits. However, with a continued struggle of a lack of housing units for year after year, a slowdown in construction is not necessarily a friend to someone looking for a break in pricing, as this could just increase the housing shortage woes. For some markets, this is less of an issue as supply has been sufficient, but for others this could offset at least some of the downward pressure caused by higher interest rates, as less construction brings less inventory to already inventory-starved markets. Nationally, rents trended downward slightly according to Rent.com, but at less than 0.5%, it's little relief for renters after 25% year-over-year rent growth. 95% of markets saw increasing rents, with Austin, Texas checking in at an astounding 121% increase in one-bedroom rents, and Tulsa, Oklahoma topping the list of two-bedroom units at an increase of almost 70%. With only 5% of markets experiencing some decline, Cleveland, Ohio was at the top of the list with a just under 25% decline in one-bedroom rents, and Chula Vista, California, getting the crown for the largest decline of two-bedroom units at over 46%. Ouch. If I haven't mentioned before, and I know that I always do, real estate is local, and if these numbers don't show you that, I'm not sure what else will. You need to be looking at your local data when assessing your markets. National information and trends are still important, as those can certainly affect local markets, but every market will react differently based on what's happening in that local economy. Never take national data and apply it as a blanket for all markets. That's how you make wrong assumptions and how you make big mistakes, whether you're a retail buyer or an investor. Okay, so what's the bottom line in all this? Stop looking at just one piece of data, or even worse, just the headlines, and look at the entire picture before drawing a conclusion. Heck, I may even be wrong, but at least I'm looking at everything I can and drawing a conclusion from that versus just following a headline or agenda-based article content. In the end, I'm still very positive on real estate and feel that if you're calculated in where you're buying and are using your financing responsibly, there are still so many opportunities out there and reasons to continue to be involved in actively buying real estate. Don't sit on the sidelines. Yes, there are some headwinds in the market right now, no doubt, but there are still so many factors in favor of real estate continuing to do well overall. As a consumer, if you're looking at a personal residence, just pay attention to what your local market is doing and lean on your experts to guide you so you can make an educated decision. As an investor, do your research. Know your market. Be strategic about where you invest, cover your downside, and be responsible with your debt, and you'll continue to do well. There are markets that will dip, but there are also markets that will continue to see price appreciation even with these higher interest rates and even if we do end up being in a recession. If you haven't already checked out my podcast, The Everyday Real Estate Investor, be sure to check that out. We talk more about investment real estate, from mindset to strategy to tools and tactics, as well as interviewing awesome guests to learn from their experience and get insights to help you achieve your real estate investment goals more quickly and be more effective in your investing. Don't forget to subscribe to my channel to stay on top of what's going on in the market and keep up on the latest podcast episodes. Thanks again for watching, and make it a great rest of the day.